Selling an investment property can result in an unexpected and large tax bill, which is why you need to make sure it's correct and also as low as possible. So firstly, we're going to talk about how to calculate how much tax you've got to pay when you sell your investment property. So simply, to work out your gain, you've got to work out the proceeds. It's pretty simple. So what you sell it for, the cost base is usually what you've paid for, and the resulting difference is your gain or loss. So that gain is included in your tax return and taxed at your marginal tax rate. Most people sit on about the 30% tax bracket. So if you made $100,000 gain, you've got to pay $30,000 in income tax. So firstly, we'd like to look at the exemptions because then it makes it easy to not worry about the other reductions and adjustments. The first one is the main resident exemption. So if you lived in your property as your main resident and you never rented it, the property is usually fully exempt. So in that situation, you don't have to worry about any calculations or any tax. Second situation is where you may have lived in the property initially and then you've now moved out and rented it. So in that situation, if you've rented in your next property, it's very common when people travel overseas or interstate for long periods of time and they leave their main resident tenanted and they're collecting rental income. So in those situations, the property is still exempt from tax, but it only is allowed up to 6 years. It's called the 6-year rule. So you can move back within 6 years, and then it resets the 6-year timer. But a lot of people that doesn't apply. So the most common exemption would be the partial main resident exemption. It's very common when you move into a home the first time, live there a couple of years, then you move out, and then you buy a new home, and then the old property is now rented. So in that situation, you can apply a partial main resident exemption. It's done based over the days of ownership. So typically, let's say the first 300 days that you had the property, you lived in it. So it's your main residence. And then after those 300 days, you decide to move out. And then another 300 days pass, and then you decide to sell the property. Those last 300 days, you're renting it out, collecting rental income. But the first 300 was your main residence. So half of the property or half of the gain is going to be exempt from tax purpose. So leading on to that question, another adjustment that is made, especially in that situation when you've initially rented the property, after owning it, after living in it, you're going to make an adjustment to the cost base. So you're going to adjust that to whatever the market value is the date you first rented it. So for example, if you bought the house in 2005 for $100,000, and then 10 years later you decide to start renting it out, at that point you're going to have an adjustment in your cost base to your the value at the date you start renting it. The reason why they allow that, or it's reasonable and fair, is because if you decide to sell it within sort of a year or so, there's going to be a very large capital gain because typically the house would have appreciated a lot in value at that time. So just be mindful to do that market value adjustment. It's going to save you a lot of tax. So the cost base, the effective cost or purchase of the property could go from $100,000 to, if the market value at that date you rented is $500,000, that's like $400,000 of capital gains that you've saved. So important to do that. Always use a real estate agent to do the valuation report. Another thing to be aware of is capital works that have been claimed previously. So if you've claimed capital works, which is depreciation on the fixtures of the property, so the building is typically claimed over 2.5% per year, over 40 years, and claimed in the rental schedule. So if you've claimed that previously, that needs to be adjusted or deducted from your cost base. So it's actually going to increase the capital gain. If you decide not to adjust for that, it's likely you will get audited because the ATO can see that as a separate label. Also, they can see what you've bought it for. So wouldn't recommend trying to avoid not making that adjustment because they'll be able to see that. So assuming you've applied all those adjustments, the last adjustment or concession we look at is the 12-month discount. So a lot of people are aware of this one, so it doesn't get missed too often. But if you've owned the property for more than 12 months and then you sell, the gain, you only pay half. So, for example, if you buy the house for $500,000 and then 12 months later, for some reason you're able to sell it for $1 million, you made a $500,000 gain, which is great in 12 months. You'll only have to include $250,000 of gain or income, capital gain income, in your tax return, and that's taxed at your marginal tax rate. So if you're not sure about your capital gains tax or the sale of your property, or you're thinking about it, it's always a good idea to reach out to an accountant. You can book a consultation with ourselves online anytime. We're always happy to help.